Good morning, ladies and gentlemen. Well, the risk dial is at -42 according to my calculations, so very much in risk-off territory. This week we get the Fed, and it's going to be all about bonds, and all asset classes are going to trade almost tick for tick with bonds. So all you have to do is look at where the bonds are going, and you will know where the S&P is going, and gold even, and also the dollar. So without further ado, let's have a look at what the bonds are most likely to do next week. I won't show you the yield curve this week because the yield curves are really doing not very much. They're quite stable, and all the moves are quite parallel in the 5s, 10s and 30s. There is a slight flattening tendency still, but that is not what's driving the market. What is driving the market is inflation, fears of inflation, and therefore absolute bond yields. Now, in 5s, I think this 213 level is absolutely critical. To me, this 177 level was critical, but now that we're through it and we close through it, 213 becomes absolutely critical. Anything above 213 and we will be in plunge mode. And that is going to be very significant. Plunge mode signifies complete panic in the stock markets. I will explain to you why the relationship is so important, but basically keep this 213 written firmly down for the 5-year note. 10s and the equivalent level is 203. Beyond 203, and I think we probably get to 250, 261 very quickly. It's as simple as that. Just keep on looking at these at the closes. The real support is 169. If we go down, which is not my preferred view. My preferred view is we still go higher and we touch 269 over the course of the next month or so. That will be plunge mode in equities, and I will show you the equivalent levels. If we look at 30s, this is the one that I think will go least, but the possibilities are really that we get to at least 272, and that would be the equivalent of somewhere around the 127 in the in TLT. Those are the kinds of levels that I'm looking for, and Europe is going to have equivalent levels which we can look at now. If it's important for you to understand that the relationship between 10-year Germany and 10-year US is actually very, very stable. We are basically trading within 10 ticks, 182, 172, what you want to do kind of thing. I still think at some stage we break down, and that's going to be very important. But I don't think it's going to happen next week. I think next week it's much more likely to remain stable, and therefore whatever happens in the US will be more or less mirrored in Europe. So having said that, if we have a look at what those levels are, this is the bobble. I think there's going to be very, very important support here around -10. And if we start breaking through 11, the move is going to be, quite strong. We can't, what can we do? Can we go to a weekly chart and see where that is? It's going to be a long way through. You can see where that level is. It's here around 25, 27 basis points. So I really don't think that there's any chance that we don't see these levels and possibly even higher levels in the 70s at some stage. To me, this is going to be absolute panic. The panic button will be pressed. So that is what I think about fives. And if we now have a look at the Bund, I don't think there's any hope that we don't get to these levels around 47, 48 basis points. France really tells me much the same. I think that we will see these levels around the 88 to 90 basis points. So everything is, it just can't hold. To me, this 81 basis points, this is 61 basis points, is going to be a gift again for some options to go higher. I think it all goes higher and much higher, and now I'll show you the reason why. And here is the reason why. I think we're going to break out here in the 5-year forward inflation expectation rates. And that, as we know, is what Powell is looking at. So if we even look now at the 10-year break-even inflation rate, that's already broken out. And there is no stopping it. It's now at 294. It's going to go over 3%. There's no way that 5s and 10s can stay in the one-somethings. I think, the move is very likely to go into the high 2s. And therefore, that's all there is to it. If Germany, i.e. Europe, is tied to the US, and the US is breaking out in inflation break-even rates and also in expectations, I don't think there is much doubt that that goes higher. And therefore, I will show you the relationship later on between the bonds and the equities. And basically, bonds are going to be driving absolutely everything next week, and certainly even for the next 2-3 weeks. The US dollar is still in buy mode. We still haven't reached 99.83 and 139, but I think we see them. And what we do then becomes critical. I don't think that we're going to break them, simply because the relationship between the interest rates in the EU and in the US is remaining quite stable. But all the pressure is still going to be on a higher dollar, and any dip to around 98.54 or even better 97.52 and 96.47, these kinds of dips, they're all buys. It definitely trades 139. That's all there is to be said about it. If we have a look at the euro, well, let's enlarge a weekly chart. Really, a weekly break at 106.96, that's 107, which is the lowest close that we had for a long time, is still going to, it just shows you the direction. I don't think it breaks down that hard, simply because of the interest rate differential being stable, but that is the way the pressure is going to be. Any kind of move above 109.92, i.e. in the 110s, is still going to get sold. This is just going to grind lower until we get to this kind of level. Gold is very susceptible to fear and the developments on the battlefield and the daily headline about what Putin is or isn't doing, or what they think he will or won't do. So it's very difficult to trade gold by itself. The thing that you have to have in the back of your mind is that if I'm correct and bond yields do start spiking now, and the US dollar does go, to that over 100 level in DXY, there will be downward pressure on gold. Simply because it's also a derivative. If it weren't for the fact that we've got this war going on, it would be quite a bit, excuse me, it would be quite a bit lower. And as you can see what happened, and I'll enlarge this, what happened last week, really it is holding, it's trading within levels very well. Where was the bottom? Right at 1959. That's where the support is. I don't think it can withstand this 2045 on a closing basis, and I think it's more likely as the fear evaporates of the conflict, and if we get some kind of sort of not dreadful resolution, that it could easily start coming off towards 1881. And, that's probably a great level to buy it. But I really am not that bullish on gold unless the headlines say that you have to be that bullish on gold. Simply because bonds and the dollar are huge headwinds for it. And I don't think, unless there is a headline that it can maintain these levels, I think it's much more likely to come down towards 1881. Well, DBC, making a fool of everyone simply because it's very, very volatile. As long as it keeps on trading in this area between 29.73 and 24.39, it'll just be it won't be either a headwind or a tailwind for bonds. Basically, this kind of level is not going to, this kind of trading range is not going to fundamentally affect bonds one way or the other. We know there is inflation. We don't know whether it's, much higher than we think or a little bit higher. I don't think that is going to be a driver. Of course, if we started busting through this, this range, it would just accelerate bonds. At the moment, I think it's a neutral development for bonds, and bonds are really what is going to be driving all the other asset classes. I don't think there is absolutely any doubt about that. So as long as it doesn't come down below 24.39, I don't think it's going to be that significant. If it starts coming down below 24.39, and the only way that could happen is because oil is absolutely falling out of bed, then that will calm down bonds. But unless that happens, I just don't think that this is something that is going to affect bonds that much. And here we have oil, just to see what that looks like, because that'll affect DBC, of course. Yeah, I would have thought that as long as it stays in this area around 97.77, it's really not going to be that impactful. So that's basically back to where we were at the beginning of the Ukraine conflict. As long as it does something like this, and this is the monthly chart as you can see, as long as it stays in this area, it's really not going to be that impactful. It's basically saying that commodities have reached a new trading level. And that is just not going to be that impactful on bonds, I don't think. I think it's, it's going to be neutral. Bonds need to adjust to the new realities. And it's going to take quite some time for this to be another catalyst for bonds. I think what we have in terms of inflation spirals is quite enough to get the bonds to the levels that I was talking about, which is only 30-40 basis points away from where they are. If this started spiking again, then you're looking for percentages. So I really don't think that this is really something that matters, even if it retraces back towards the mid-90s. These are the only charts you really need to look at the moment. And this is SPY TLT and SPY IEF. You can see how the relationship is extremely tight. I've been saying for a long time to you that bonds and equities are tied at the hip at the moment. And that is still what's happening. And that is why I keep on saying that to trade the stock market, all you need to know is where bonds are going. So I've given you the levels, the break levels in bonds. If they start breaking, the stock market will start breaking. I'm betting quite heavy that this relationship remains intact, that it doesn't move a million miles from here. I have a fundamental reason why that is so, and I believe that basically the stock market yield and the bond market yield will remain pretty constant. And that is why as soon as you see which way bonds are, you can jump all over the S&P. Here you have the daily relationship. The previous chart was a weekly one. This is a daily one between SPY TLT and SPY IEF. You can basically see how tight the correlation has been over the past, let's call it 6-9 months. Really, this is what, April 21, and we are now basically a year with this having gone nowhere. SPY TLT, bonds and equities are tied at the hip. I just don't know how, what more proof anyone would need to see that. If it starts breaking down, that is very bad. That is recession. Okay, that is absolutely recessionary. So what is this saying? This is saying that really, if we start breaking down through these levels, and of course I will tweet that to you, then we are accelerating away from that relationship, and the stock market is now fearing recession. I think that that's far too early. Even if we do get a recession, it's not going to happen now. That signal is not going to come. It's just unlikely to come now. The odds are too low. I'm aware of the possibility, but I think the odds are far too low. And if I think that bond markets are now going to go another 20-30 basis points, that tells me that the relationship is going to remain pretty constant, and really the pressure is going to be on equities for that 20-30 basis points, but no more. Let's examine why I don't think we will see recession or the market pricing recession anytime soon. This is XLY, XLP, and as you can see, we are reaching levels that are very, very good support. A recession, to me, would have prices at least below this 217 level. And as you can see, this is basically where we were and trading before COVID. And then we had, when we came out of COVID, we went up. And this is now basically at that support where we were before COVID, when S&Ps were trading 3500s. Okay, so it leaves quite a bit of room for the S&P to come down, but it's also saying don't get overexcited here, because you really would need a signal to go much lower. So that to me is another sign that we've already priced in the fact that growth is going to be slower, the consumer is going to have less money, everything that we know is most likely to happen. For recession to happen, I think we would already be down to through 217. So I really don't think recession signals at the moment are that likely. And this is the equal weight consumer staples over discretionaries. they've shown you that there is some more room to the downside. Can we get to these levels? Yes, absolutely. But for real fear to happen, we would start breaking 71. And as you can see, this is COVID. This is the panic. I don't think that's going to likely happen anytime soon. So I'm naturally watching this. To me, it says, is there room for equities to adjust more to the downside with bond? Yes. But are we going to get a recessionary panic? Not soon. That's all that this is saying to me. And I'm watching these spreads all the time. And if these things change, I will naturally tweet it to you. Right, so distilling what I've said so far, bond yields, if we get bonds at 251 and if we get the 10-year note at 230, something like that, what is the S&P going to be worth? Well, the S&P is going to be worth 39.43. I would have thought that that is more or less your mathematical equation. That is the level that we get to. We are basically now below 42, 47 on the weeklies. Over the course of the next few weeks, it's going to open up and we will get down to 39.43. That is basically what I think all the spread charts are saying, that the relationship between TLT and SPY is going to be firm, that the relationship between the consumer discretionaries and the staples will continue to hold in at the levels that I showed you. It's not going to show recession, and therefore that the level that you are likely to get to in terms of a washout in S&Ps is 39.43. That nicely fills in a few gaps, and then we start bouncing from there together with bonds. Now, of course, that means that the Nasdaq goes down more than the S&Ps. If that is the case, let's have a look at where it's likely to go. This is NDX over INX on a weekly basis. Well, this is the 200-week moving average. Why don't we touch it? Why don't we go to 3 from 315? So that's another 5 extra % of move for the Nasdaq against the S&Ps. Looks reasonable, right? And now let's have a look at what that would imply for the Nasdaq. Well, it would imply this kind of level. Anywhere between 12,439 and 11,846. That's what that implies, or even down to 11,276. This is the kind of stuff that it implies over the course of a few weeks. I would like that because we fill in all these gaps, and we've then filled in all the the worst expectations the bonds have got to as bad as they can get for the time being. We've had a complete washout in everything, and it's going to be a great level to start about getting long again. You can see where this gap is. Wouldn't it be nice to go and fill it? 11,276. It's not going to happen next week, but it's going to take several weeks. But when the bonds are at my target, I would have thought we are in that kind of area. Another reason why I don't think the stock market will need to price in a recession is because transports are far too high for that. We're not a million miles away from really good levels in the transports. This would be much, much lower if the market thought there was any chance of any kind of recession. And also the Dow is holding in relatively well. the Dow is the most sort of value oriented of the indices, and it's really not that bad. Does it have room to come down some more towards the 30,000 area? Yeah, absolutely it does. But that is not a complete, a complete shambles and a market that is looking for recession. I think anybody who is looking for recession at the moment is going to be deeply disappointed. You would need some very, very bad developments in Europe and in the war to start thinking about a world recession. And you will also get a much, much stronger move down in transports. So these are all the reasons why I don't think we are, headed for a catastrophe. I think we're just headed for a move in bonds which discount the present level of inflation and the fact that the Fed is probably going to have to be quite aggressive to tame it. And therefore yields go up, and therefore the S&P and the Nasdaq follow it, follow the bonds, and the relationship between bonds and equities remains quite firm. What about Europe? Well, what about Europe? The relationship between Europe and the US gyrates wildly. And it's gyrating wildly for very good reasons, i.e. everyone is out, and B, or has been stopped out, let's say, and B, it just depends on headline to headline. What is likely to happen? These levels work very well. Why change them? I got lucky at 33.81, and that's as soon as it got to the moving average, I was out. I think we retest the 33.81, but I think Europe starts calming down. Europe has discounted a hell of a lot, and Europe is extremely cheap by historical standards to the US. Therefore, I don't think the relationship now between Europe and the US is going to move a million miles unless we get some very, very bad headlines. Could we get them? Yeah, sure. But can you anticipate them? No. Can you formulate a strategy of hope for a headline? No, you can't. Therefore, you can only react to it. I think we stay in this range, and possibly if the headlines out of Russia, Ukraine are not as bad as people might fear, that relationship between the US and Europe could actually start coming in, and it's quite possible that if and when the S&Ps are going down to those new lows that I described earlier, you don't get much lower, if at all lower, than 38.81 in Europe, and you hold in. That is probably the path of least resistance. But I think all these stock markets are now tied in with their bonds, and therefore as their bonds give up ground, they will give up ground with them. There is absolutely no reason to look to buy EEM yet. I think that, as you can see, this is EEM, EWJ, EEM, EWG. So this is Japan, this is Germany. Basically, it's stable in a big range. The only one that it's collapsing against is the US. New all-time weekly close, lows close. The direction of travel is quite clear. And if we have a look at EEM itself, I don't think there's much chance of not coming down and trading even this 37.60 level, from where I think is going to be a great level to buy it. I mean, this is going back to 2012. So it's just, there's just no point holding EM for the time being. It's much more likely to come down than go up. anything around 45.04 is going to be sold quite heavily, and that is why I still think that the overall direction for equities is lower, much more so in EM than anything else. And S&Ps are going to be the last ones that that go down, but the direction of travel there is down as well with the bonds. Basically, all we do next week is we look tick for tick for the bonds and we follow them in the S&Ps. I've updated all the levels in, and really all we have to look for next week is this. We look at where they're going, and these are the levels that they're likely to stop at. And when they stop, the SPX will start, stabilizing. Basically, I think it's going to be as simple as that. Monday and Tuesday are going to be headline days, i.e., what's happening in Russia, what's not happening in Russia. Wednesday is when the real move starts and should accelerate over the next few days and even the week after. Thank you very much indeed, and tweet you on Monday. It should be an exciting week.